G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm your host, Aaron Christie David, and each and every week we bring into the studio someone we call best in breed, so someone that's at the top of their game, someone that lives and breathes and eats property, and someone that wants to see their clients succeed in the game of investing in property. My mantra is very, very clear when we talk with our clients. It's buy with confidence, build a quality portfolio, and ideally build intergenerational wealth through investing confidently in property. And to help you on that journey, there are people that come along for the ride with you that want to see you succeed and prosper. And those people we feel are buyer's agents as part of the mix. And today we're joined in the studio by two quality guys, Bobby Haeri and Darren Venter from the Investors Agency. And I feel like I should be getting an honorary shirt. By the way, I've got the white shirt, just no logo.
Sorry, mate, it's in the post.
It's in the post. All right, I'll take that. I take a large, by the way.
Because all those buses. You've got to make space.
I'll take a medium just on time. How you guys doing?
Very good, mate. Very good. Thanks for having us.
Thanks for being here. I mean, Bobby was saying before, it's the shoe's on the other foot because you run your own podcast and now you're a guest. How does it feel to be on the other side of the table?
I much prefer to be a guest. I feel like being a host, it is a little bit more stressful. You got to run, not to put pressure on you by any means, but it's like, you feel responsible if it's not running smoothly or if things don't go according to plan as they are as a guest. That's how you feel like as a host, but as a guest, it's just you come on and you have a bit of a banter and have a bit of fun.
Interesting perspective, because I feel like I have a responsibility to deliver real content. So it's not sales pitch, it's not, hey, clickbait. It's giving like real good, valuable, again, the value of your time, your energy, your insights. But for people listening, it's like I have a responsibility to give you something that's off value as well, isn't it?
Yeah, 100%. 100%.
Perfect. So before when we kick off, I like to start with what I call the 3 Ps. So a bit about yourself personally, a bit about yourself professionally, and a bit about your own property journey, and that usually is what you're comfortable to share and divulge. I mean, we're having a quick chat. I'm going to look at you first because you're directly close, but having a chat about family and the evolution to now becoming a father. So might start there.
I'll start out. So personally, a father of 2, had my most recent child 3 weeks ago.
Yeah, congrats.
Thank you very much. Got a girl who's just over 2 years old as well. She's like 26 months. Loving being a father, married to my wife, been with her for 16 years.
Wow.
Thank you very much. Professionally, had the Investors Agency for 3.5 years.
Yeah.
Before that, had a landscaping business for about 11 years where we employed 10 staff, and that allowed me to open up the Investors Agency and spend my time full-time on the Investors Agency. Yeah. I don't have the landscaping business anymore. Yeah. I've been quite fortunate where the Investors Agency has got me to a point where I've been able to step away from landscaping because property has always been my passion.
Fantastic.
In terms of property, I bought my first property over 10 years ago and have been continuously buying since across the eastern seaboard of Australia.
Congrats, mate. Well done. What a journey.
Thank you very much. Thank you.
And 3.5 years in, I almost said the journey's just beginning, right?
It feels like it's been 10. It feels like I've aged 20 years in the past 3 years. But
I didn't have grey hair, so I don't know which was it kids or was it the business? I don't know. I'm blaming one of them.
But I've been loving the journey. We're quite lucky that I think both of us doing something that you love. Yeah. We're quite fortunate in that regards that we have a passion that you can monetize.
And a unique journey where it's a partnership as well, right?
Yeah, the partnership's been incredible. I think we started that sort of 2 years ago, almost now.
Nearly 2 years.
That's turned into, or bloomed into a lovely blossom, and it's definitely doing well for the business.
Well done.
Yeah,
congrats. Yeah. Like any relationship, right? 2 different perspectives. Two different ways of viewing the world and how you want to run a business.
Strengths, absolutely.
In our business, we call it healthy friction. So it's like, okay, what's your outlook? How do you feel that way? And take it on board and grow and get better. So
100%.
Darren, tell us more.
Personally, from South Africa originally. Came over when I was 22, I think it was, as a jewellery designer. Got out of that career about 5 years ago. But since 2017, been in the property game. Started up the business Strat Prop, which is when we started talking together, right back in few years back, I think.
Few years, yeah.
And then that went really well. But as businesses go, things evolve, and you can only really grow with as many hands as you have.
Yeah.
And that's kind of where the partnership actually came into play.
Yeah.
So, personally, professionally rather, we went into the partnership now 2 years ago, where we merged Stratprop and the Investors Agency.
Yeah.
And then, that's where it's at today.
Well done.
Property-wise, as I said, entered into the property game around 2017-ish.
Yeah.
Been buying across the country as well. Nice little portfolio on my hands. And
well done.
Yeah, just keep on going.
Excellent. And like I said, living and breathing property, right? So it's not only for your clients, it's for your own self as well. So when I say failed forward, have there been learnings along your own journey that you go, hey, look, I can see you're going to make that fatal error, for example, this is the headwind that you're going to face. And then you've seen some people that have really kind of shone under your mentorship as well, right?
Absolutely. I think, I'd say Bobby's probably got more property buying personal experience than myself.
Yeah.
Obviously, you've been doing it since 18?
10 years, 12 years.
12 years now.
Yeah, right.
But you learn a lot along the way. And if you've got a good arsenal around you, some good legal help and some good people around you and some good mortgage brokers.
It's one piece of the puzzle, right?
Yeah, exactly. You need it all together.
Finance is one part, then it's your structure, so your tax effectiveness, for example, that's going to get you to another stage, especially if you're self-employed, as you just mentioned. And then it's property management as well. So that's going to I call them the goalkeeper almost, right? Defending your asset, and then
that's it.
100%.
Yeah, and then you need those relationships, whether it's doing it yourself or going through a buyer's agent. You then need to double down on, say, investing in yourself.
Yeah,
and your own knowledge as well.
Yeah, absolutely, 100%.
Yeah, perfect. So take me through. Well, I guess one of the big beliefs that you have is around positive gearing and being cash flow positive, for example, and you've got a real, emphasis on that. So take us through why the emphasis and why that particular strategy as well.
Cool. Do you want me? I'll start, and I'm sure you'll have plenty to add to it as well.
Yeah.
So for us, with positively geared property, most of our clients, or all our clients, don't just look to buy one property.
Yeah.
They want to buy 2, 3, 4, 5.
Yeah.
And I feel the reason why 90% of investors get stuck at 2, it's because they're buying 1 or 2 negatively geared properties. And the banks, they're not looking favorable towards them. It's costing them too much to hold. Me personally, my first property was a small owner-occupied. It was a Sydney Northern Beaches purchase. It was a 1-bedroom, quite a small one. If I wanted to buy another one in Sydney, I wouldn't have been able to. So, that's a lesson I learned very early on. Well, I need to buy a positively geared property so I can add to my income and I can continue borrowing from there.
Yeah. And to that point, Bobby, and this is what we talked about a lot, and you'll hear me say this a lot if you've been listening. When you're younger and you're trying to get into the market, you're limited by 2 things. You have a very small deposit because you're young and you haven't been earning a lot. And the next one is your income level is the lowest it ever will be in your lifetime. But you've got this hunger in the belly, I want to buy a property. And so you're literally just buying whatever you can to get into the market, which is great, but it also means potentially you buy the wrong type of asset because you're buying cheap to get into the market. I can say that firsthand because that was my experience. Like, just buy anything to get into the market.
Yeah.
That's what our parents are probably telling us as well. Just get into the market. And it's like, I'm in, but now I've probably got maybe the wrong type of property perhaps as well. I mean, one better on Northern Beaches. That's a good place to start.
Well, with that, we're quite lucky, and I guess it's a lesson for the listeners as well. It was owner occupied. We were just moving in. It was a 1-bedroom, but it had a 90-meter exterior, so garden apartment, north facing. So it was quite. I guess we don't buy apartments for clients ever. We always buy houses. Yeah. But if someone is really looking to buy an apartment, I guess the one thing I would say, and I was going to mention this when you said some lessons learned along the way.
Yeah.
Look for something that's unique. Like, look for something that has a big terrace, or look for something that has a big courtyard. Look for something that has high ceilings and is north facing. Look for something that's in a small block. Otherwise, if you're just buying that 2-bedder
homogenous
in a big high-rise building where a developer can buy another block next to you and build another 300 units, well, there's your oversupply issues straight away.
Saturation will just take over.
Yeah.
But also, obviously, just stay away from the passion purchasing, because that's, obviously, when it's right on your doorstep, it's a lot easier to find, and mum and dad are obviously going to give you the clap of approval there. But the passion will bring you close to home because it's easy and it's where you feel comfortable. But the data can obviously always help with that sort of.
It's a really interesting one, Darren. And I mean, there's a great, I believe the 2 researchers out of Sydney Uni, and they did the research piece, which was I think 66% of investors will buy close to home. I'll bring up the article and I can share it as well. I've reached out to them to try and get them on, so that's a bit of mention. But the research showed that that's what investors will typically do, is try and buy close to home. And in the last few years in the market, it's hard to deny because everyone did very well. So it's hard to disprove that everything went up, right? So it's hard to deny that strategy worked. There are some investors that doesn't matter what you say. You could literally put 2 properties, have all the numbers there, and then they'll go with that one that stacks up. But then you kind of reveal it and go, that one's interstate, and they'll freak out and take the property that's maybe less valuable or has less return on investment. So I guess you're dealing with that maybe slight bias as well. So how are you talking clients through that bias? I feel like it's getting a little bit better now because people are just going, look, I'm a borderless investor. Probably thank COVID a little bit for that as well. But I guess you still may have some clients that are like, I'm not sure about Perth. It's done nothing for 10 years, gone backwards, and now it's like the hot spot, for example.
Exactly. I mean, look, there's I wouldn't say there's an exact, there are equations to it, obviously, because that's exactly what the banks work off.
Yes.
The long and short of it, and a quick way to look at it, is that if you're earning less money, you need that property to create more. Because essentially the bank looks at your income and they're going to service you against that.
Yeah.
If you can get a higher yield on that property, which supports itself and repayments, it's going to be less of a liability on yourself. And therefore the bank will like to lend more according to that. If they see that you have a higher income and you're able to support the life journey of that property, then also the bank will be of an understanding profile that you can support that property.
Yeah.
And therefore you can put your cash into lower yielding equities or lower yielding properties.
Yeah.
And capitalize more of that cash flow. I mean, more of that equity gain.
Beautiful.
So, I mean, that's the basic rule of thumb. Obviously, you know about that game in and out.
Preaching to converted.
Yeah.
I get it. And I'm glad it comes from you because every single buyer's agent that we talk to, it's like, work on borrowing capacity first. Because if you can break through that, the property is just the outcome.
Yeah.
Not just, but there's no borrowing capacity or serviceability with that to then enable you to build or scale your portfolio.
Yeah, without being able to get the finance, without being able to sort of fund that purchase, there's no purchase, right?
Correct.
So that's the first step. Let's see how much you can borrow.
Correct.
Then from there, we can see how we can sort of help you.
Yeah.
But it's also about buying the right asset that will allow you to buy the next one. Because if your lending is then capped, then you obviously can't.
Yeah, correct.
So it's balancing it out.
Yeah. And again, personal experience share, for example, have you experienced where you've maybe run out of equity or run out of borrowing capacity and then had to kind of think about your next maneuver after that, and how do you navigate those?
Fortunately for me, no.
Yeah.
But that's probably because I went into the buying game a little bit later.
Yeah. Okay.
So for me, yes. Yeah. So my first property in Sydney, if I was to buy another property in Sydney, I would have been maxed out.
Yeah.
That's why I went regional. Also, I then had to go and put a few granny flats in to then increase serviceability to then continue buying.
Yeah.
So yes. As banks get tighter with lending and you reach those, as long as if you want to stick with a top tier lender where you've got your 7 times debt to income ratio, there is a point where your secondary dwellings and granny flats really play a part.
Correct.
However, if you're comfortable to go to third tier lenders, then that's a different story. Interest rates with them is also a different story at this stage as well.
I call it pay to play.
Yeah.
So if you want to get the property, then there's a price to pay. It's literally to get in, and then once you're in, it can change, right? Once you've got the property, then the uplift, pull the equity out, for example, then you pay with LVR. So again, it's that whole, I want to be very, very clear that this conversation is general in nature and not intended to give advice. You probably should have started with that. But again, everything that we're seeing, all roads lead back to this is a game of finance. Unlock that, and then you can unlock the scalability part of building a portfolio as well, because you can have all the hunger in the world and all the means to grow and all the knowledge, but if you don't have the finance piece, it's going to stunt your growth.
100%, that's right.
And what I call the frustrated investor. Perfect. So someone comes to you, you take a brief, for example, and then the secret sauce is how you then put this deal together and how you go about securing it. But a combination of here's what we're looking at, here's the data, here's what we're seeing on the ground, for example. How do you piece that together and start to present options to your clients, guys?
Well, I think for us, it starts, we sort of do a scenario case where we'll have a look at a client situation financially, because that's essentially the tools we're using.
Yeah.
And then make a scenario out of that. If we purchase this property, is it going to allow us to buy another property? If the answer is yes, then we'll proceed into at least that market or at least that property type. Once we know what that looks like, then we'll disclose the markets that can then obviously support that path forward. And if our clients are happy with those markets, then we'll go and head into those markets. Once we presented the markets, we'll then go into the property that we find inside it that basically supports the returns that we're aiming for. And that's basically the beginning part of it. And obviously that's, looking for properties was always the fun part. Exchanging that contract and getting the building and pest and all the other nitty gritty afterwards is what a lot of the team go through every day. And we've got an incredible team, and Mike, our head buyer, basically controls all of that. And does a fantastic job at it. But it does get tricky, and there's a lot of fun until that point as well. And a lot of people forget about the fun. So secure the right asset in the right market, because obviously that's going to help you to get the next property. But so from then on, we'll conduct the building and pest inspection, as we do with Mike. Mike will then go through it. But our agents on the grounds and all the different markets that we're shopping in will help us secure some good walkthrough videos, so we have a good understanding of what those properties look like.
Lovely.
And then construct the contract based on what we see in those walkthrough videos. I mean, that's basically our negotiating game. So we can exchange the contract, which is fine, but then up until that unconditional phase, you still got to make sure that everything is correct on that property, and whatever's been negotiated on the contract is actually foreseen until that unconditional stage. It's not like New South Wales, So in New South Wales, you do all that stuff before you actually go into the exchange.
So sorry, you go? So in Queensland, it's a mad rush to sign the contract, and a lot of people don't even review anything. Like I bought property personally, sight unseen, just with the clause in there, subject to an inspection. You can't do that in New South Wales. So it's just every state has different rules and regulations. And Darren touched on something at the very beginning of the process, which I think is really important for the listeners to do, because I don't think many people do this. Figure out what kind of property or what kind of results you need from property number one, which will help you get into property number two. That's really important. You can do that by speaking to your mortgage broker. Your mortgage broker, if they're investment savvy, they'll say, based on your finances, on a $500,000 purchase, you should aim to get $550 per week rent. And when you do get 10% capital growth, that should put you in a position to buy your next property, assuming that lending doesn't change. Lending criteria doesn't change. And I think that's another reason why 90% of investors get stuck, because they're like, well, I've got $1 million pre-approval, let's go buy a $900,000 house. Well, then you're stuck because it's costing you $200 a week to hold on to. But if you find what kind of property you need to buy your next one and having that conversation with your mortgage broker, then finding out what markets will give those results, that's going to put you in the best position to continue purchasing.
Well said. That's one part. And then the next part that we see generally is lifestyle creep. So as your income goes up, there's discretionary spend goes up. Maybe there's throwing a car lease in there, for example, credit cards that people refuse to cut. And the challenge now is those parameters are set, and now maybe the goalposts have moved a little bit. So again, it's going to, if you're hungry to grow, then it's like help us help you is the message that we generally say to a lot of people as well.
Those goalposts are moving daily at the moment.
At the moment, right? Like every RBA rate increase changes it. Every living expense, every time you move up, for example, rent, bonuses will put you maybe into a different living expense category, for example. Lender selection, that'll change. And I mean, it won't surprise you guys because you've probably been through cycles, Bobby, as well. So you come into favourable conditions that we've had for the last few years, it's open slather for lending. That starts to change a little bit, and then banks' risk appetites will then change. And then in turn, it's like they can easily just flip the switch on. And we saw that, interest only a few years ago, for example, just overnight policies will then change. So you got to be ready to adapt. And that's the word that I'm saying frequently is adaptability. And that's probably a great lead into the next question, which is goalposts are moving. So you take Queensland, for example, and the land tax changes. You take stuff we're seeing in Victoria, for example, landlord, a lot of the rules are changing there. There's talk about rental freezes, for example, stamp duty changes in New South Wales. Then you go, there's a lot. You can go, there's a lot going on, and that can be all the reasons to say no, but there's plenty of reasons to say yes. So how does adaptability, how does that ability to kind of rise above all those changes, does that come up in some of your conversations as well?
Yeah, definitely. I think let's take the Queensland land tax for example. I personally feel the impact it's going to have. I was speaking to our accountant that we work really closely with, and he was crunching the numbers, which gave me some clarity on it. Yeah. Originally, I thought it was going to have a major impact and everyone's going to rush out the Queensland market and it's going to be a fire sale, essentially. When we crunched the numbers, we sort of realized that you're only really getting hit with $10,000, $15,000 tax bill if your property portfolio across the country is very considerably high. So if you've got $4, $5, $6 million, if you've got like a $5 or $6 million property portfolio, you can afford a $10,000 tax bill. I'm just using rough numbers, right?
Correct.
But it's not like someone who's got one property or two properties worth $1 million is going to get hit with $10,000.
Correct.
It's going to be based on your wealth. If you can afford that many properties, then I don't want to pay the tax, but you're in a position to pay it.
Correct. It's you're in a privileged position if you own that certain level or value of assets, and it pushes you into that different category as well. It's, I guess, no different to the extra tax that comes when you're positively geared. You're making money, now you're paying tax, and you can't complain about it because you're making money now as opposed to losing it. Yeah. These aren't the reasons to invest. If you're trying to minimize land tax, for example, it's again, we call it pay to play. They're the rules of the game, and unfortunately, politicians can change the rules of the game, but lending has changed dramatically. I mean, from the time that you probably got your first loan to where you are now, it's a completely different kettle of fish. Yeah. To the way that you bought your first property, buyer's agents then even then it was probably in its infancy, and now it's coming to quite a different stage where it's maturing a little bit more, it's adapting and being sought out more as well, right?
Yeah, 100%. But yeah, I think you touched on. I think there are always going to be rules and regulations and things that come into play. You should focus on what areas are going to give the best performing results. Yeah. If Queensland is going to be the strongest performing capital city, paying tax on a property is no reason not to buy there. Yeah. Buy it, get the strongest capital gains, and then pay the tax. That capital gains will far outweigh the tax you're going to pay. That's how we see it.
I mean, how many people come to you and say, is now the right time to buy property? And how many times have you heard that over how many years have you heard that?
You should have bought it like 8 years ago.
Exactly. And it's all circumstantial because it's always reliant on something happening in the market that's freaking people out. Right. But the bottom of the line is that, properties continue to grow in value. Yeah. And had you done what you intended on doing 2, 3, 4, 5 years ago, when you asked that question the first time, you'd be way more well off at this stage.
Yeah, it's almost the trigger. If you're asking the question, then it's almost a self-fulfilling prophecy. Is now the right time to buy? Well, why isn't it?
Yeah.
Yeah.
Yeah. And so if people are asking themselves, is now the right time to buy? I did an article in a group that we have on Facebook yesterday, I think it was, where there is nearly 1 million visa applications in the work, not all coming into Australia, but a majority of them are, which they're trying to get through. The immigration system is trying to get through it. They've just employed 500 new staff to just get through these visa applications. So every time there is a downturn in Australia, it's the Australian government who opens its borders, ramps up migration. You get a flood of people coming in.
Those people need somewhere to live. Exactly. They're generally going to rent as soon as they get to this country, at least for the short term, until they can get on their feet. Yeah. I want to jump the gun here, but supply is drying up, for example, and then you're going to have this wave of demand, or at least a more consistent demand as well coming through. And so, if we're not having enough new builds coming through the pipeline, but so it's a good amount of demand, it should support a fairly buoyant market for some particular areas, and some may, again, a normalised property market where some will outperform and some will have those periods of lull as well, isn't it?
100%. And I if you ever speak to a buyer's agent or a real estate agent, they're never going to say now's not a good time. But for those listeners, I'm happy to share. I exchanged on my most recent last week, and I know you're happy to share. It was only a month or two ago. Yeah.
We're constantly
you're putting your money where your mouth is.
Exactly. Right. No one's ever going to say now's not a good time if you're in the real estate space. But if we're saying we're actually buying in today's market, we honestly believe in the industry that we're in and where the property market's going to go when this flood of migration comes in.
Yeah. That's something again, when I'm talking to buyer's agents, it's you're living and breathing the advice that you're giving. So if I'm telling clients, you're telling clients to buy, then it's like, we're buying, it's skin in the game, isn't it?
Yeah. 100%.
So we'll talk about, I guess, your philosophy and your outlook. So take us through typical clients, for example. What do they look like, and who's the clientele that you serve Because, I mean, the investors agency lends itself to predominantly working with investors, right?
Yeah, well, obviously, yeah. So it's all investors, but it is a very wide scope of profile, I feel. The reason why we do that whole balancing act in the beginning of understanding sort of what type of asset to purchase for the highest yielding or the lowest yielding for the highest growth return is because we've got such a wide demographic of clients.
Yeah, okay.
So we've got some very established clients with some very good portfolios on their hands already.
Yeah.
And we're just repurposing a lot of their equity into more purchases. The older they get, they want to create more cash flow.
Right.
To create that retirement plan. So we're aiming for those types of properties for those guys. But then we get all the way down to like the first home buyers that are still living with mum and dad, and they are saving up their pennies because they can't afford to buy in the northern beaches of Sydney.
Yeah.
So they're going to put the cash into something that is going to work for them for that eventual return. So it's really broad. It's a very wide range of clientele that we serve. But essentially, it's guys that have got not enough time on their hands that want to, and they actually understand and respect the returns that a property can provide to them.
Yeah.
Not just a property, but a high-performing property.
Yeah.
A lot of our structure is based off imminent growth and then long forecast growth.
Okay.
The imminent growth is there to essentially try and create your deposits for you to buy another property, to create a deposit for you to buy another property, and so on and so on. It's balancing that for each individual, and those individuals are, there's quite a few different types of characteristics about them. Professionals, tradies.
Predominantly or resi, or what's your mix?
Or resi. Resi only, We look for land. Yeah. So it's houses again. Obviously, best yieldings, most of my bedrooms. And then depending on what you're looking for in the equity, is going to be capital demand. So how much is the shortage of supply? What is the forecast of population movement over a certain amount of time? And we kind of match the economics with the profile of our clients, just to try and balance that out for them.
You mentioned something before, Bobby, where it's like we want to look for something that's a point of difference in this property, what I'd call like an X factor, for example. So and this is why I ask a lot of our buyers agents from a trained eye, because you're seeing hundreds or thousands of properties come through your mix and saying yes or no, yes or no. So what is something that makes the cut, for an example, that you go, hey, that's got an X factor about it? And what is something you'd say, that's a strong no to, that if you weren't trained and had the trained eye for it, that you may actually fall susceptible to buying a property like that as well?
Yeah, so that example I gave was for apartments in terms of something that's more unique. But in terms of houses, like a lot of our SMSF clients, they don't want something that is you can build a granny flat or add a bedroom. Okay. It's just set and forget, low maintenance. Yeah. They don't want to touch it for 20 years. They just want to triple their money in 20 years and let it sit there. Yeah. So it depends on the client. But if our client is not an SMSF client, or our client is looking to potentially add value, generally weatherboard we steer clear of.
Okay.
Generally pools we steer clear of.
Yeah. One of the things that we do look for is there's always a demographic of land size, or a median of land size within that area. We try to punch above it, because that's going to be that, and that's not a huge X factor, but it is the point of difference. Yeah. So if the market's generally, and we call a suburban market, and if that market's median size of land is 450, we'll try for 550.
Right.
That's going to be the point of difference on that market.
Awesome. Yeah, nice. And from a house perspective, you probably were seeing clients that maybe didn't take your advice and gone and bought something, and they come back and you're like, we would have prevented that type of purchase, for example, and here's why. Like, what are some of you mentioned pool, for example. It's people, especially like Queensland. I feel like if your house doesn't have a pool, it's not a house. Yeah.
The first thing that comes to mind there was one of our staff's friends spoke to one of our staff members to help him purchase a property potentially, was asking for his advice, and he gave his advice, and then they went and did a purchase themselves. Yeah. They went and did a purchase in far north Queensland and got their insurance bill of $8,000 a year.
Right.
And they're obviously in the red, well and truly in the red. That's $8,000 insurance, because you're in far north Queensland is going to be a big hit to your bottom dollar. Yeah. Also, far north Queensland, if you get a cyclone, or you go through a rainy patch and you lose all your tenants or whatever it might be, these are some of the things that people don't think about.
No, a lot of insurers look at, I don't know if it's the 23rd or 26th latitude, but north of that, it's pretty much the Harvey Bay line. Anywhere north of that in the tropics, insurance has started to increase dramatically. It's not off the normal scale. It's because of the cyclonic weather up there. So there's a lot of markets.
It's a tip for new players, isn't it?
Absolutely.
Yeah, that's the first thing that came to my mind. I don't know if anything comes to your mind in terms of what people have done where we shook our heads a bit.
Well, look, and it's we like to buy established properties just because we know that the returns are, you can see what's going on in the market and you can actually run with that race rather than building. So we don't necessarily look for new builds, purely, or rather building and home and land packages and stuff like that. We like to, and we do understand the values of those assets and potential clients that would want to buy those. It's not to disown them at all, but we like to get in with the growth and then hold that growth as it grows. But if you're in for the depreciations and if you're in for the capital gains after a period of time after building, absolutely, that's your game as well. But for us, we kind of stay away from that because we want to run with that race of growth while it's happening.
Beautiful.
Yeah.
I feel like one of the lesser talked about strings to your bow is accountability. Here's what happens. You'll do an annual review on your client's portfolio, right? It's coming up. It's I'm assuming it's part of your process.
Yeah. Doing it actually this week.
There you go, right? It's the same for us. And run your property report. Here's your equity position, lower the rate, for example. And then you'll get in touch going, hey, did you know you got equity? And so you mentioned there before that they're time poor. They're not checking, right? They've almost delegated, not abdicated, but delegated that to you guys. And it's like, that's that responsibility now, isn't it? To say, actually, did you know that it's gone up in value? We potentially could look to go again. And if they were DIY, they maybe wouldn't have that level of accountability or someone that's watching their portfolio as they would their own.
100%.
Yeah. So we've actually got a little setup because we buy everything for our clients through their app. So every client gets their own app.
Oh, nice.
They see the whole process go through. It's directly connected to our CRM. So whatever we do, it's instant updates. They get to see exactly where we are. And part of that package is once you do purchase it, it goes into their portfolio section. We don't, obviously, again, it's not financial advice, but what we do is we take the market's growth inside the area and we attach it to the asset's value. And we'll predict an approximate growth of equity within that property.
Wow.
That goes into the portfolio section of the app, and that gets done every quarter for them.
Yeah, right.
Yeah. Excellent. So they do get to see that, which is really handy. And, you can call John up and say, hey, John, it's been, 10, 12 months, whatever it is. Well, every quarter, so 9 or 12 months.
Yeah.
You've got another 16% growth. Have a think about putting some equity out.
Our whole business model is based on recurring clients and building, not just buying one property, it's recurring properties for clients. So that's why we have Darren's a whiz with tech and set up heaps of good systems and structures and whatnot in the back end. He has a love-hate relationship with it, but he's good at it. So.
I just want it to work. That's my relationship with it.
So Darren helps set that up and it is because so many of our clients are return clients. They're not just buying one. So it's been a game changer for that regard.
Excellent.
As well.
And I don't think opposition is the word, but they may need a little bit of help to then say, hey, look, you can think a bit bigger. And I think we think bigger for our clients and sometimes they think for themselves. Now, it's not tooting our own horn. I think genuinely we have an optimistic view of the world, which is, hey, look, you can go again. And I don't know. And do you feel like you have to then kind of say, look, are you ready to go again? Is there that element to almost like coaching a little bit?
Not really. I think a lot of the time we get clients who are super cautious and super concerned at the beginning. And they have $1 million pre-approval, for example. They're like, look, I've never bought an investment property. I've never bought a property interstate. I'm not comfortable with it. I just want to buy one and see how I go. Touch wood, they do buy that one and then they're like, well, that was really easy. The tenants are paying on time. The house hasn't fallen down. The market's gone up. Can we do it again? Nice. So it's generally that first time that a first-time buyer or a first-time investor might be a little bit concerned. When they've experienced it, they realize it's quite easy and they'll second time is far easier. Second time, they're the easiest clients we'll ever have. It's just like, you tell me to buy, I'll buy. It's just like, sweet, anything.
It's a vote of confidence then, isn't it?
Yeah, exactly.
Yeah, getting them across the line into those markets that they don't know about in the beginning and educating them about the economics inside it. That's always tricky, but when they do come back for the second time, it's just like, yeah, cool, whatever you say.
Yeah.
Not so much with everybody, but there's always, it's a lot easier.
Yeah, perfect. So I guess from your own journey and what you do is, for your day job, for example, what's your parting advice for someone that's looking to build a portfolio? And it's, I guess I'll leave it up to you to answer.
Parting advice for someone looking to build a portfolio. I would say ignore the media and educate yourself. They're probably the biggest, because like we just went through a pandemic. Now we're going through inflation. We're going through interest rate rises. But if you look back over the last 20 years, there's been the Afghan war, Iraq war. There's been tech crash, GFC, COVID. Like there's been so much, and this will continue happening. It will happen over the next 50 years. Interest rates will go up. They'll go down. I guess you just need to ignore the media, but educate yourself to know what all these things mean and how you can protect yourself. If you don't have time to educate yourself, then just get a good team around you who can just do it for you.
You took my two.
Sorry.
Educate and get a
well, at least we're singing from the same hymn sheet here for you guys. So,
we're together 8 hours, 9 hours a day. So
yeah, I would say the same thing. Educate yourself, but if you can't get the right team around you, it's vital. If you're going to be taking a stab in the dark, it's only going to be as good as you hope. You can't make those predictions without some knowledge. And if you don't have the time to learn, then get somebody to help you.
Yeah, beautiful.
But also get in. Just do it. Yeah, don't wait.
Yeah, that's often people's regret, isn't it? 2 regrets. I wish I got in earlier and I wish I didn't sell that property. It's kind of what we hear is common ones, isn't it?
Or I wish I bought more.
That's the other one.
I wish I didn't turn that one down.
We
get that quite a lot.
There you go.
Our clients will maybe get, because they don't have to obviously purchase everything that we present to them.
Yeah.
But once they do get presented something, if it doesn't tick their approval, that's fine. Maybe it was too quick that we presented. They leave.
That's an interesting one, isn't it? When it happens too quickly, it's like, oh, freaked out. I thought it was going to take a bit longer, and this happened far too. It's almost like when a restaurant brings their meal out too quickly. It's like, what happened here?
And then all of a sudden it sells for $25,000 more, $50,000 more, whatever it is.
Yeah. Okay.
And so that's sort of, I told you so. But you don't want to, I told you so.
Yeah. No one wants that.
No. Yeah, we've had instances where clients have said no to a property because of $3,000 or $4,000, and we never force a property on a client. We can try to talk them into it, but if they're not comfortable, that's fine. Yeah. If you think about like a $400,000 property and it goes up by, let's just even say 5%, that's $20,000. You're missing out on a property for $5,000. It's completely irrelevant. Looking back 6 months, and for your repayments, it's 10 cents a week or something. I don't know, making that up. But that would be another thing. Like if you know it's a good property in a good market and you can afford it, don't lose a deal just because of a couple of grand. Don't get emotional and be stupid, because there's lots of good opportunities out there. But don't. A lot of the time it's sort of like we find it's a pride thing. It's like, no, I've come down this much. I've come up this much. I want the seller to do this as well. So I feel like a lot of the time, put your pride aside, and if it's a good deal, just go for it.
Put your pride aside. I like it.
And speaking to that point, I've heard from agents now that's something that's happening on the vendor side. Someone comes with a lowball offer, their pride is saying, well, I don't want to deal with that person, and strike them off the list. And it's like, the real estate is probably saying the same thing. Put your pride aside, and it's we say we're trying to create a win-win-win-win. Yeah. So a win for yourself, a win for the vendor, a win for say a real estate and a buyer's agent. Like it's not win-lose. I think that's how we're conditioned to negotiate. It's win-lose, but actually it could be a win-win. Yeah. They're getting the price that they deserve. You're getting the price that you want. The agent and the buyer's agent have done their job, and they're getting paid their due rewards as well. Like there's nothing wrong with everyone winning.
And it's all circumstantial, right? So someone getting into a property at a certain time, it's a win for them because they've got another 20 years ahead of them. Someone looking to retire and selling that property, it's a win for them because they need that cash to go and spend in retirement. So it's circumstantial.
Correct.
So. Don't be afraid to make those decisions that you want to make though as well, because a lot of times when we do have a client that feels it is too quick and they pull out of that opportunity, it might take another month to present to them.
Oh, totally.
And if you're in a property market that's growing at 2% a month, and you're on a $400,000 property, that's $8,000 of loss that you've just lost out on that growth. Yeah. So it's
good point.
Look at, obviously be realistic, but obviously palatability is a big thing as well. Does it suit your palate? Is that what you're looking for? Are you comfortable to buy it?
Comfortable to buy it. You don't have to see yourself living in it because you're not living in it. Someone else, with all due respect, will. But as long as it's meeting your criteria, it's passed your gold standard test as well, and it's going to deliver the results that you're expecting, then at that stage, it's why not as opposed to why, isn't it?
Yeah, 100%.
Beautiful. Hey, guys, thank you so much. Really appreciate it. The way this rolls off your tongue, it's clear that this is your day job, and it's also what you live and breathe, which is what I said at the start. So I want to say thank you very much for your time. Thanks for your shares as well. Really appreciate it. And what we are going to do is for the investors agency details, we'll include Darren and Bobby's info down below. So if you do want to reach out to them, we say to everyone listening, do due diligence, find the partners that you feel aligned to you from an ethical and from a business standpoint, and also what they're looking to achieve personally and professionally. So I hope that's been helpful. If you have found that helpful, please leave us a review or drop us a note with some questions that you want answered for future episodes, and we'd love to help you on your journey as well. Guys, thank you very much. That's a wrap for another episode. We'll see you soon.
Thanks, mate.
Thanks, mate.
Thanks.